Did you know there's a simple, yet incredibly powerful trick that professional traders use to stay in the game long term, while most beginners blow up their accounts? It's not some secret indicator or a magic formula. It's something far more fundamental: percentage-based risk management. Stay with me for the next few minutes, and I'll break down exactly what this is, why it's a game changer, and how you can implement it in your own strategy, starting today. So, what's the big idea? In simple terms, instead of risking a fixed dollar amount on every single trade like $100, for example, you risk a fixed percentage of your total account balance. Let's say you decide to risk 1% of your account on any given trade. If your account has $10,000, your risk on the next trade is $100. Simple enough, right? But here's where the magic happens. Let's say that trade is a winner, and your account grows to $10,500. Now, for your next trade, you still risk 1%. But 1% of $10,500 is $105. Your potential profit on the next trade just got bigger because your account grew. This is how you organically scale your positions and compound your gains. Your winning trades have a bigger impact as your account grows. Now, let's look at the flip side, which is arguably even more important. Imagine you hit a rough patch. It happens to everyone. Let's say your $10,000 account takes a few losses and drops down to $9,000. What's your risk on the next trade? It's still 1%, but now it's 1% of $9,000, which is $90. Notice what just happened. As your account balance decreased, the dollar amount you're risking also automatically decreased. This is the built-in safety mechanism that protects your capital. It's a concept called anti-martingale. When you're winning, you press your advantage by risking slightly more in dollar terms. When you're losing, you pull back and risk less, preserving your capital so you can stay in the game and wait for your luck to turn. This systematic approach prevents the catastrophic losses that wipe people out. Think about it: risking a fixed $100 per trade when your account has dropped to $1,000 means you risking a whopping 10% of your capital on a single idea. That's a recipe for disaster. A percentage rule automatically adjusts to prevent that from ever happening. So, how do you actually implement this? It's a simple three-step process. First, you need to determine your risk percentage. This is a personal decision based on your risk tolerance and your strategy's win rate. A common starting point for many traders is between 1% and 2% per trade. If you're more conservative or have a lower win rate, you might choose 0.5% or 1%. If you're more aggressive and have a high-performing strategy, you might go up to 2% or even 3%. But anything higher is generally considered very risky, especially for beginners. The key is to pick a number that lets you sleep at night, even if you hit a string of 10 losses in a row. Step 2 is figuring out your stop loss. Before you even enter a trade, you need to know your invalidation point. Where will you get out if the trade goes against you? This isn't just a random price. It should be based on your technical or fundamental analysis. For example, it might be below a key support level or above a resistance area. The distance between your entry price and your stop-loss price represents your risk per share or per unit. The third and final step is calculating your position size. And this is where it all comes together. You take the dollar amount you're willing to risk, which we calculated in step 1, your account size times your risk percentage, and you divide it by your risk per share from step 2. The formula is position size equals account balance times risk percentage divided by entry price minus stop-loss price. Let's walk through a concrete example. Imagine you have that $10,000 account and you've decided on a 1% risk rule. That means you are willing to risk $100 on your next trade. You identify a stock you want to buy at $50, and your analysis tells you that if it drops below $48, your trade idea is wrong. So, your stop loss is at $48. The risk per share is the difference. 50 minus 48. which is $2. Now, we use our formula. Your position size is $100 your total risk divided by $2 your risk per share. That gives you 50 shares. So, you would buy 50 shares of that stock. If the price goes up, great. If it drops and hits your stop loss at $48, you'll lose $2 per share on 50 shares, for a total loss of $100, exactly the 1% you plan to risk. Not a penny more. This method forces you to be disciplined. It removes emotion from the position sizing part of your trading, which is often where traders make their biggest mistakes. They get greedy after a few wins and take on a massive position, only to give back all their profits and then some. Or they get scared after a loss and take a tiny position on the next trade, which turns out to be a huge winner, and they barely profit. Percentage-based sizing smooths out your equity curve and keeps your risk consistent, trade after trade, day after day. It also makes your strategy adaptable to any market and any time frame. Whether you're trading volatile crypto or stable blue-chip stocks, whether you're a day trader or a swing trader, the principle remains the same. The math automatically adjusts your position size based on the specific volatility and setup of that particular trade. A trade with a wide stop loss will naturally result in a smaller position size, while a trade with a tight stop loss will allow for a larger position size, all while keeping your total dollar risk constant at that 1% or 2% you decided on. This isn't just a suggestion. For many professional traders, it's a non-negotiable rule. It's the foundation upon which a sustainable trading career is built. It's what separates the professionals from the gamblers. A gambler is focused on the potential reward of one trade. A professional is focused on managing risk across hundreds or thousands of trades. So, your homework is this: open up your trading platform or a spreadsheet. Look at your total account balance, decide on a risk percentage that you are comfortable with, and before you take your next trade, do the math. Calculate your position size based on your entry and your stop loss. Make it a mechanical part of your process. At first, it might feel a bit slow, but soon it will become second nature. This single habit has the power to protect your capital, improve your discipline, and ultimately, transform your trading results. Thank you so much for watching. I hope this breakdown was clear and gives you a practical tool you can start using right away. If you found this helpful, please give this video a thumbs up and consider subscribing for more content on building robust and profitable trading strategies. Drop a comment below and let me know what risk percentage you use, or if you have any questions. Trade safe, and I'll see you in the next video.